as far as India macro goes, and that's something that I'm going to be talking about on the editor's cut today. But Alex, over to you, because there is good news for India macro, maybe not so much for staples.
Yeah. In fact, I was going to start, Niraj, by saying to all the economists and to all of the students of economics, this is not an April Fool's joke. You've not seen this ever, but you might just see it for the first time ever. If I'm not mistaken, the current account deficit turning to a surplus in the fourth quarter.
Okay. Yeah.
We are starting with that because how big of an update is that for the Indian economy, which has been seeing its deficit narrow over a period of time with the advent of IT services and various other exports that are taking charge, as well as the inflows that the country is seeing, particularly in the fixed income space. Bond market inflows coming through. But is that the clincher? What is pointing towards this surplus?
Yeah, so from the dark days of CAD numbers being so low, as both of you would remember 10 years ago, if somebody would have said at the start of this decade that India will be CAD surplus, you would have mocked, scoffed, smirked, what have you. And you're right, this is not an April Fool joke. We don't know if it's a done deal as yet, but here are two notes, and I'm essentially standing on the crutch of two notes which are saying that this could happen, Nomura as well as Citi, right? And here's what they are arguing. So Nomura says that Q1 24, which is the quarter gone by, may record a current account surplus of 0.5% of GDP. Citi's estimate is slightly different. I'll come to that as well. Let me wrap up Nomura first. They say that the merchandise trade deficit has remained capped unscathed by the Red Sea disruptions, and the services trade surplus is exceptionally strong, reflecting one strong IT exports that are happening and consulting gains that are happening. And in addition to all of this is the strong remittance number into India. Never mind what's happening or what may happen in Middle East because of lower oil prices, the remittance numbers are looking very, very strong. So, and of course in the note they say that they expect FY25 CAD averaging 1.1% of GDP. So they expect that FY25 will be a deficit again.
Oh, will be deficit.
Yeah, it will not be a surplus. The surplus is restricted to Q4. But be that as it may, one, I don't think we've seen this. And two, I think as many people have said in the past, and as you can argue, right, we don't want to be a country which is current account surplus because we are a growth economy. We don't want to remain in a surplus for too long because that will impede growth. So you want a current account deficit, but you want a manageable current account deficit because it will not have any untoward pressure on the INR. So that's the prima facie basic economics. Just to round up what Citi is saying as well, they say that available data shows current account balance likely to turn surplus into Q4, something that Nomura is arguing as well. The numbers are slightly different, of course, and they say it mainly reflects seasonal improvement. You were asking about the cues for this. Yes. So one, seasonality impact out here, seasonal improvement, which might have been accentuated by some favorable macros, like growth numbers in India, like remittances, like stronger IT exports, like stronger consultancy exports. So that is two. And they say FY25 CAD could well be below 1%. So Nomura is about 1.1% current account deficit for FY25. Citi is averaging about 0.7 to 1%. So yes, a current account deficit, but manageable. And the balance of payment will likely be in surplus in all 4 quarters in FY25.
Did you by any chance, sorry, before you come to that, did you by any chance look at the estimates for crude oil prices in those reports? Yeah,
so for FY25 that they are penciling it is 0.7 to 1, they are factoring in you would call it benign, 70s. Crude priced in 70s. Now, if crude were to go to 90, 100, then it's a different kettle of fish. The numbers may move from 1 to 1.2, 1.3, whatever the estimates may be. But here's what gets interesting, and I'll make it very quick here. Beyond Q4, Q4 is surplus, great. What beyond Q4, right? I gave you a brief synopsis, but the larger summation is that they believe it will be range-bound, 1% of GDP, resilient global growth, particularly manufacturing activity leading to strong export volume growth. By the way, guys, European growth is picking up. And we spoke to Robert Sorkin on the morning show. He's speaking about this as well.
Research.
Yes, Citi Research. Early 70s, the answer to your crude price, early 70s per barrel oil implies about a $20 billion YOY fall in the annual oil import bill. So that's factored in when they are taking in CAD at 1% and strong remittance inflow to aid the CAD numbers. So confluence of factors, but yes, I'm thrilled by the fact that something that people would have only mocked 3 years ago about CAD numbers looking very positive for India could actually be turning out to be a reality, even if it's for 1 quarter. And as I said, we are happy with being current account deficit as opposed to current account surplus.
And
I just wanted to comment on the crude part of it, because you said $70 to $75 a barrel.
Yeah, they're talking
That's
about
what
70s,
they're talking
early
about,
70s,
which
yeah.
basically means there could be output cut actions coming in this year, if that's the thing, because that's not what OPEC plus is gunning for, right?
Yeah, possible. I would believe, Sajeet, but I would believe, Sajeet, if global demand picks up, US, Europe, etc.
the price will go automatically go up.
No, prices may go up. The OPEC may then not be tempted to do cuts because some people will say,
But
okay,
in that
let's
sense,
take advantage.
But that gentleman is a conversation for another day, because
Yeah.
we're going to head into crude prices and where they're headed. And I don't think anybody at this juncture will be able to decide very
exactly,
or understand where it's heading. Let's talk about inputs though, because that is going to be the second conversation that we're having today. We're seeing, and we saw the headlines, Sajeet, just last week or the week before that, cocoa futures going to what, 10,000?
Yes, 230% up year on year.
And it's not just cocoa, it's all input prices. So what we're effectively saying is that with FMCG companies biting the bullet and saying, look, we're not going to raise the prices just yet, we're worried about volumes, is the time of margin expansion over?
It's more of an underperformance year for FMCG if you look at that way. In the sense, in FY24, the index went up by nearly 19%, while the Nifty 50 was up 31%. And in the last 3 months, it's fallen by nearly 5%, while the index was up 3% odd. So it's underperforming the index by a big margin, and it is also now a neutral to underweight for in many of the portfolios. For last 6 to 9 months, it's been that way, and it's going to continue that in FY25 as well, as input prices are going to go up. So prices for sugar, coffee, cocoa, edible oil, lab
for detergents
prices,
as well.
Lab, which is used in detergents, and some fatty acids which are used in soaps and detergents have all gone up in double digits.
In March?
In March, and over a period of year on year and month on month and quarter on quarter, they have been going up. So there is a double digit inflation which is coming into FMCG inputs going forward, and that would mean that many of the companies' earnings are going to be hit, because on EBITDA level they've been able to expand the margin, and they've been able to push prices by 5 to 6% last year. Will they be able to do it in FY24? It's very unlikely.
FY25 you mean?
Yeah, FY25 is unlikely because there is a demand sluggishness which is coming in. Rural is just picking up. That's what we are hearing, that some green shoots seen. Demand in urban are little flat to marginally positive, which is there. So will they be able to push the prices across again in FY25? Is going to be a big challenge for me, because the question is whether you're going to go for volume growth or for margins.
And so far, what they've done is they've prioritized margin growth very clearly. Volume growth very clearly.
Yes, that's it. And they're going to, and many of the top companies are going to ensure that their market share remains the same, which basically means the volumes have to be the priority here rather than margins there. And if that happens, we're looking at earnings impact of 50 to 100 bips on the EBITDA level for many of the companies and across categories, which is going to come in.
Is it still the case that, and this is my last question on this because it's really straightforward in that, and I believe we have a report, viewers, on the website ndtvprofit.com by our colleague Sesha, who's spoken to a number of companies, and among them Parle Products is talking about 8 to 10% inflation in their commodity basket.
And they're not willing to pass on
prices. So the question is it what we saw last year and possibly also the year before that, is that domestic unlisted players, very small brands, particularly in the rural area, are pulling market share?
That's going to happen. I think downtrading is going to happen. Like we saw in 22-23, where we saw local players picking up a large chunk of the market share because they've been able to push volumes at a lower price. And because at that time, FMCG companies were very firm on maintaining margins, so they lost out some of the market share to the local companies, and then they came into the market with volume, pushing volumes there. So we're going to see something of that dynamics playing out again here. It's going to be very, some of the regional players are supposed to, we should be looking out for some of the regional players, especially in the FMCG space, not the soaps and detergents also, but some of the
Snacks and stuff.
snacks and
Yeah.
others, because that's going to be something which will be they will be
Neeraj,
pushing there.
so the final point, does it reflect in the values, in the valuation?
Shameless plug. Watch out for 9:30 a.m. today. We'll be talking to Abneesh Roy, who will be giving us an insight on this. Yeah, it'll be interesting to see. I think depends on how they are mixing up the ingredients, price targets versus everything, and the commentary coming in for Q1. So I'm really keenly watching out for that. But more than that, I think the results will show, and we'll figure out at 9:30 a.m. today on NDTV Profit. So viewers, tune in.
The question that you need to ask is there a runway for FMCG going forward in FY25?
That's one of the questions that will be asked for sure. Abneesh Roy, Executive Director, Nuvama Institutional Equities, will join at 9:30, and they'll be talking about FMCG. So watch out for that.